Welcome to the Trendline Gala podcast.
It's great to be here. Today we're pulling back the curtain on something most of us do or think about doing, but maybe don't fully understand.
Exactly. That simple little tap on your phone. You see a stock you want, you tap buy, and then a second later you own it. It feels like magic.
It really does. The technology is so seamless that it seems instantaneous.
But it's not magic, is it? I mean, what actually happens in that split second between my tap and the shares showing up in my account?
No, definitely not magic. What you're tapping into is an incredibly complex system. It's built on rules, super fast technology, and a whole chain of different people and companies.
A chain.
A whole chain. Think brokers, exchanges, market makers, all working together just to process that one little instruction you sent from your phone.
Okay, so that's our mission today. We're going to break this down. We're going to follow that tiny instruction step by step from your screen all the way to the finish line when you actually legally own those shares.
Right. And understanding these mechanics, the nuts and bolts of it all, is really the first step to becoming a more informed investor.
It stops being this mysterious black box.
Exactly. So let's walk through the whole thing. Let's start right at the beginning with step one, sending the instructions.
Okay, so let's unpack that. Before you can click anything, before you can even think about buying a stock, you have to start at the same place as everyone else.
You need an account, a brokerage account.
Right. And you can't just, walk onto the floor of the New York Stock Exchange with a $100 bill and ask for some shares.
No, those days are long gone. Your brokerage firm is your portal. They are the licensed gatekeeper that lets you into the market. They're the ones who can actually talk to the exchanges on your behalf.
And there's so many different kinds of these gatekeepers now.
Oh, absolutely. The whole landscape has changed. You have the discount firms, which are super popular. They have the slick apps, zero commissions,
They're all about low cost.
low cost, minimal services. And then on the other end, you have the full service firms.
That's where you might get a financial advisor, someone to help with planning, research.
A lot more hand-holding for sure. But here's the key thing, and this is important.
Okay.
Whether you're using a simple app or a big fancy firm, the very first part of the process, the instruction you send, it starts exactly the same way.
Which brings us to the order. That's the official term, right?
Yeah.
When I tap buy, I'm sending an order.
You're sending an order, and an order is just a set of instructions. It's you telling the system exactly what you want it to do.
So what's in those instructions? What are the essential pieces of information?
You can boil it down to three key things. First, and this is the obvious one, is which stock you want. Its ticker symbol.
Like XYZ Inc.
Exactly.
Yeah.
Second, how many shares you want. Are you buying 10 shares? 100, just one.
Okay, stock and quantity. Makes sense. What's the third?
The third one is maybe the most important. It's how picky you are about the price.
How picky I am.
Yes. And that's what we call the order type. It's where you start to take real control over the trade. Your choice here can really change the outcome.
So let's look closer at that. Because for anyone just starting out, this feels like the first big decision you have to make. There are two main flavors, right?
Two fundamental types that everyone should know. Let's use a simple analogy. Imagine you're at a shop, and there's one last item on the shelf that you absolutely have to have right now.
Okay, I'm with you.
You don't care about the price tag. You just tell the clerk, I'll take it. That's basically a market order.
A market order. So the instruction is, buy this stock from me right now at whatever the best price is at this very second.
Precisely. And the big guarantee with market order is that it will happen. The system's number one job is to get you those shares or sell your shares immediately.
So I'm guaranteed to get the trade done.
You are. But here's the trade-off. You are not guaranteed the exact price you saw on your screen a second ago.
Ah, okay. So the price can move.
It can move in milliseconds. If you see a stock at $50, by the time your order zips through the system, it might be $50.01. It's a tiny difference, usually, but in a really fast-moving market, it can be more.
So with a market order, you're choosing speed and certainty over a precise price.
You've got it. Speed over precision. Now, what if you're not in a rush? What if you're more strategic?
That's the other flavor, the limit order.
Yes. With a limit order, you are setting the rules. You're telling the system, I only want to buy this stock if I can get it for X price or even better.
So if a stock is trading at $50.05, but I think that's too high,
You could place a buy limit order at, say, $50.
and my order will just wait.
It will wait, it sits in a queue,
Yeah.
and it will only execute if and when the market price drops to your $50 limit or lower.
So with a limit order, the guarantee is that I control the price. I'll never pay more than I want to.
Exactly, but the non-guarantee is that the trade might not happen at all. If the price never comes down to your level, your order just sits there. It might eventually expire.
So it's precision over speed and certainty. That is a fundamental difference. And that choice really is the starting gun for this whole process we're following.
It is. It's the very first instruction that shapes everything that comes next.
Okay, so my instructions are sent. I've decided I want 25 shares of XYZ Inc., and I've chosen my order type. Now, this is where I think a lot of people get it wrong. My order doesn't just fly straight to, say, the NASDAQ, right?
Absolutely not. That's a huge misconception. Your app, your website, it's not talking to the exchange. It's only talking to one place, your brokerage firm,
The middleman.
the essential middleman. And their job is way more than just passing along a message. They're the air traffic controller for your trade.
So they get my order first. What do they do with it?
Well, their computers instantly spring into action. First, there are some basic checks. Do you have enough money in your account? Is this a security you're even allowed to trade? Things like that.
The basics. The basics. But then comes the big decision, and it happens in a fraction of a second. They have to decide where to send your order to get it filled.
And they have a choice.
They have a choice. And they have a very serious legal obligation here. It's called the duty of best execution.
Okay, that sounds important.
It's the bedrock of the whole system. Your broker is legally required to seek the best execution reasonably available for customer orders.
Meaning they have to try to get me the best deal.
The best deal possible. They can't just send it to the place that's easiest for them or the place that pays them the most. They have to have a system in place that is designed to find the most favorable terms for you, the customer.
I noticed you said for customer orders, plural. What does that mean? Does it mean they might not get the absolute best price for my one tiny trade if it helps the system overall?
That's a very sharp question. The legal language is in the aggregate. It means their entire system for routing orders has to be set up to deliver the best results for all of their customers as a whole.
So while they're absolutely trying to get the best outcome for your specific trade, they're doing it within a framework that's optimized for millions of trades. And usually that means focusing on getting the best price.
And a big part of that is something called price improvement.
Yes. This is a fantastic concept for beginners to understand. Price improvement is the chance, and it's not a guarantee, that your order could get filled at a price that's actually better than the best price you see publicly quoted.
Wait, how is that possible? If the best price to buy is $10.05, how could my broker get it for me for $10.04?
Because not all price quotes are public. The public quote, what we call the national best bid and offer, might be $10 to $10.05. But a specific trading venue, a market maker, might be competing for business by offering a slightly tighter price internally.
Like a private little discount?
Kind of, so they might be willing to sell to you at $10.04. If your broker's smart routing system finds that better price and sends your order there, that one penny you saved. That's price improvement.
I see. So the broker system is constantly sniffing out these tiny opportunities.
It has to, but it's not just about price. Best execution is a balance.
What else are they balancing?
Speed is a huge one. What if one venue offers a tiny chance at price improvement, but it's a bit slower? In a fast market, that little delay could mean the public price moves against you, and you end up with a worse price.
So it's this constant calculation. Risk versus reward, speed versus a slightly better price.
And also the likelihood of execution. If you have a big order, it might be better to send it to a place with tons of buyers and sellers, even if the price is a hair worse, just to make sure the whole order gets filled. It's a complex, automated decision that they make for you in an instant.
Okay, so the broker has my order and has decided where to send it. Now we get to a really interesting part, because the market isn't just one building in New York anymore.
Not at all. That's probably the biggest change in the last 30 years. The market is now a decentralized electronic network of competing places to trade.
And the broker has to choose from that menu of options. What are the main choices?
We can group them into three main buckets. First, you have the traditional stock exchange, think the New York Stock Exchange or NASDAQ. These are what we call lit markets because all the prices, the bids and asks, are displayed publicly for everyone to see.
They're transparent.
Very transparent. They're sort of the reference point for the whole system. The second bucket is something called an alternative trading system, or ATS.
You sometimes hear these called dark pools, right? Which sounds a little ominous.
It does, but the purpose is pretty straightforward. They're just non-exchange venues where buyers and sellers can be matched up, often anonymously. They're really important for big institutions that want to trade huge blocks of stock without tipping off the whole market and causing the price to move against them.
And the third place the order could go.
Is to a wholesale broker-dealer, who we usually just call a market maker. These are big firms whose entire business is to stand there and, well, make a market in a stock. They're ready to buy from you or sell to you at any given moment.
Okay, so the broker has these options. And this is where things like how the broker themselves makes money comes into play,
Yes, and it's important to be transparent about this. One way is called internalization.
which sounds like they just keep it in-house.
That's exactly what it is. If you want to buy 10 shares of XYZ and your broker's firm happens to have another customer who wants to sell 10 shares of XYZ at the same time, they can just match you two up internally.
Or they might even sell me the shares from their own inventory.
They can do that too. It's very efficient. But they still have to give you a price that's as good as or better than the public price on the exchanges. That best execution rule always applies.
Okay. Now, for the term everyone's heard of, especially with the rise of zero commission apps, payment for order flow.
Right. PFOF. This is the engine that really makes zero commission trading possible for most people.
So let's break it down really simply. How does it work?
Remember those market makers, the wholesale firms. They want your trade, especially small retail trades, because frankly, they're not very risky and they come in predictable patterns.
They want the volume.
They want the volume. So to attract that flow of orders from brokers, they will pay the broker a tiny fee for sending the orders their way. We're typing fractions of a penny per share.
So the market maker pays my broker, and in exchange, my broker uses that money to cover their costs and lets me trade for free.
That's the business model in a nutshell. It's created a ton of competition between these market makers, all fighting for the right to execute your trade.
But again, the best execution rule has to come first, right? They can't just send my order to whoever pays them the most if the price for me is worse.
That is the critical regulatory firewall. The payment cannot be the reason for sending the order. The quality of the execution has to be the primary factor. It's a delicate balance, but that's how the system is designed to work.
Okay, so no matter where my order ends up, an exchange, a dark pool, a market maker, it's now in a place where it needs to find a match. And to understand that, we need to speak the language of price.
We do. We need to understand three keywords: bid, ask, and spread.
This feels like it goes back to a basic farmer's market. For any deal to happen, you need a buyer and a seller to agree on a price.
That's the perfect analogy. And the stock market's computer system is just a super fast way of organizing all the buyers and all the sellers. The system constantly knows the single best price someone is willing to buy at and the single best price someone is willing to sell at.
So let's define those terms. Let's start with the buyers. That's the bid.
The bid is the highest price that any buyer anywhere in the market is willing to pay for that stock right now. It's the best offer to buy.
So if I want to sell my shares instantly, the bid price is what I'm going to get.
Correct. Now on the other side, you have the sellers. That's the ask.
Sometimes called the offer price.
Right. The ask is the lowest price that any seller is willing to accept for the stock right now. It's the best offer to sell.
And if I want to buy shares instantly, the ask is the price I'm going to have to pay.
You've got it. So the bid is the top price for buyers. The ask is the bottom price for sellers. And there's almost always a little gap between them.
And that gap is the spread.
The spread. It's the difference between the best bid and the best ask. It's a tiny built-in cost of trading.
Okay, let's use the simple number example to make this crystal clear.
Let's do it. Imagine we're looking at XYZ stock. The highest bid from a buyer is $10 flat.
So someone out there has an order in to buy at $10.
Exactly. At the same time, the lowest ask from a seller is $10.05.
So someone else is ready to sell, but not for less than $10.05.
That's correct. So in that case, the bid is $10, the ask is $10.05.
And the gap, the spread, is that 5 cents.
That 5 cents is the spread. And a trade only happens when one of two things occurs. Either a buyer gets impatient and agrees to pay the seller's asking price of $10.05.
Or a seller gets impatient and agrees to take the buyer's bid price of $10.
Someone has to cross the spread. And for very popular, heavily traded stocks, that spread might only be a penny because there's so much competition. For a smaller, less traded stock, the spread could be much wider.
Okay, that makes perfect sense. Bid, ask, spread. That's the language. So now, our order has arrived at the venue. How does it actually get matched?
This is the magic of the order book. It's a giant electronic list of all the pending limit orders, organized by price and then by time. First in, first out.
So let's go back to our two order types. I send a market order to buy. I'm the impatient one. What happens?
Because you sent a market order, you're saying, I want it now. So the system immediately looks at the ask side of the order book and grabs the cheapest shares available. In our example, it would buy them for you at $10 or 5 cents. We call that hitting the ask.
What if there aren't enough shares for sale at $10.05 to fill my whole order?
Great question. That's called depth. If you want 100 shares, but there are only 50 for sale at $10.05, the system buys those 50 and then instantly moves to the next cheapest seller, who might be asking $10.06 to get your other 50.
So my average price might be a little higher than I thought. That's what people call slippage.
That is exactly what slippage is. It's the risk you take with a market order. Now, what about the patient trader, the one who sent a limit order to buy at $9.95?
They weren't willing to cross the spread.
Nope. So their order just gets placed in the order book on the bid side at $9.95, and it waits.
Just sits there.
It just sits there. If the market price comes down and sellers start hitting that $9.95 price level, the order will get filled. If not, it won't. It's that simple. Price control, but no guarantee of execution.
Okay, but what if there aren't enough buyers and sellers lining up at the same time? This is where those market makers we talked about become really important, isn't it?
They are absolutely critical. Their entire job is to provide liquidity.
Which just means making it easy to buy or sell something quickly.
Right. Market makers are always standing by, quoting both a bid and an ask. They are the shopkeeper that's always open for business.
So they're always there with a sign saying, we'll buy from you at this price and we'll sell to you at that price.
All day long. They take on the risk of holding the stock for a few seconds or minutes, and their goal is to make a tiny profit on that spread over and over again on millions of trades. They are the grease that keeps the gears of the market turning smoothly.
So most of the time, for a small order, this matching process is seamless. But trades don't always go perfectly right. Sometimes you might get a partial fill.
Yes. Non-execution is common with limit orders, as we said, but partial fills can happen, especially if you're trading a stock that doesn't have a lot of volume or if the market is going wild.
So I might put in an order for 1,000 shares, and the system can only find sellers for 700 of them right away.
Exactly. It fills what it can, and the rest of your order might wait or get canceled. It's just the system doing its best to fill your order without causing a huge disruptive price swing. It's a feature, not a bug.
Okay, so the match has been made. The computer found a seller for my shares. We are almost at the end of the journey. What's step 7?
Step 7 is confirmation. The instant that match happens, the trade is considered executed. A contract has been formed.
And this is when my phone buzzes and the app updates.
That's the moment. It shows you the fill price, the actual price you paid, and how many shares you bought. And then your broker is legally required to send you a formal trade confirmation, usually by email, with all the nitty-gritty details.
So that's my receipt. The trade is done. I'm officially a shareholder.
Well, almost. The shares are in your account, the money is taken out, but the actual official legal transfer of the assets, that happens in the background.
And that is the final step. Step 8, settlement.
Settlement. This is the plumbing of the financial system. It's not glamorous, but it is absolutely vital. And it's handled by separate companies called clearing firms.
So after the trade is executed, these clearing firms step in. What's their job?
Their job is to eliminate risk. They step into the middle of the trade, becoming the buyer to every seller and the seller to every buyer. They guarantee that the seller actually has the shares and the buyer actually has the money.
So if one side defaults, the clearing firm makes sure the other side still gets what they were promised.
Exactly. They take on that counterparty risk. And they also make the system incredibly efficient by netting out all the trades at the end of the day.
And there's a specific timeline for this, which actually just changed recently.
It did. For a long time, settlement took 3 days, then it was 2 days. Here's what we know now. In the US and Canada, the official settlement timeline is now 1 business day, or T+1.
T+1, meaning the trade day plus 1 business day.
Right. So if you buy a stock on a Monday, the trade executes instantly, but the money and shares don't legally formally change hands until the end of the day on Tuesday.
Why do they shorten that window?
Purely to reduce risk in the system. The longer the gap between trade and settlement, the more time there is for something to go wrong. A firm could go bankrupt, a market could crash. Shrinking it to 1 day makes the entire financial system safer and more stable.
That's fascinating. It's this huge, invisible safety net that the average investor never even sees.
Which brings us to the final thing you, the listener, should always do.
The final checklist.
Always check your trade confirmation. Check your account statement. Make sure everything matches exactly what you intended to do. The right stock, the right number of shares, the right price.
Because now you know the whole process. You know it's not magic.
It's not magic. It's a series of clear steps, legal duties, and incredible technology. And understanding that process gives you the confidence to participate in it wisely.
So to quickly recap the whole journey, you start by sending an order, your instructions. Your choice of a market or limit order is your first big decision.
Then your broker gets it and has to find the best place to execute it, fulfilling their duty of best execution.
The order then goes to a trading venue where it gets matched with another order using the language of bid, ask, and spread.
You get an instant confirmation, while the final legal settlement of cash and shares happens the next business day, T+1, to keep the whole system safe.
It's an amazing process, from your screen to the clearing firm and back again, all in the blink of an eye.
Understanding it really does change your perspective. You stop seeing random flashing numbers and you start seeing an organized, efficient transaction.
If you're a beginner and want to understand markets and trading better, you can take our free beginner trading quizzes at trendlinegala.com.
Next time, we'll talk about why prices move news, emotions, and crowd behavior so it doesn't just feel like random numbers on a screen.
Thanks for joining us at Trendline Gala.